All right, guys, so this segment, you've completed the financial inventory and you told the client, hey, I'm going to put you on a brief hold. So at this point, I want you guys to understand, if you don't already, that normally with mortgage protection, we have two options: normal mortgage protection or equity protection. When we're looking at normal mortgage protection, it's basically if the person is younger and healthier, they can qualify for term. We use the term to typically match the mortgage term and the coverage that we're covering. Okay, if that makes sense? So how I normally illustrate that, if we're going back to our previous example, if someone has a $300,000 mortgage, we would take that amount, right? And it would be 100% of 300,000, 75%, and 50% of the three options I'm going to show. All right, and that's if the client, like I mentioned, is young and healthy and they could qualify for term. Those are the options I'm going to show. Typically, the way that I do it, and your underwriting could be a little different, is I might go through Americo, their HMS series, or Family Freedom Term with Prosperity. Again, your manager, your mentor should help you with the underwriting process. But term, again, is 100%, 75%, or 50% of whatever the loan amount is, and they're typically younger and healthier. When we're doing equity protection, because you might come across someone who's 70 years old and they have a $300,000 mortgage. Well, we know at 70 you can't get term. You can't get $300,000. So how do we show the value in the product? And that's what's called equity protection. So let's say, going back to a different example, if I'm talking to Bob, who's 70, and we did the financial inventory, so we found out he has $200,000 worth of equity in his home. We're essentially going to protect the equity, the $200,000, because he can't get an insurance product that's going to pay $200,000, okay? Because his loan balance is $200,000, or I'm sorry, his loan balance is $300,000, but his equity is $200,000. So we're going to highlight the factor that we're going to protect the equity, and how we do that is through equity protection. Typically, with equity protection, like I mentioned, we're using whole life insurance, which face amounts could be $30,000, $40,000, up to $50,000, depending on the carrier. But yeah, so we're taking a whole life product and using that in the monthly mortgage amounts. And how we illustrate that when we're explaining equity protection is, hey, Bob, you're able to cover the mortgage payments for 18 months or a year and a half, 12 months or a full year, or 9 months. This way, it's going to help Mary not have to rush from the funeral home to the real estate office, and it gives her enough time where she doesn't have to make those mortgage payments for a full year. That's what equity protection is. And how I normally illustrate that to the client is we want to explain to them what equity is and the value in equity. So sometimes I'll say, hey, Bob, just so you know, obviously if something were to happen to you, if you drop dead next week, the bank isn't going to demand Mary to pay the full $300,000 loan balance. All they care about is someone's able to maintain that $2,000 monthly mortgage payment. So all we have to do is, obviously, if someone doesn't make those payments, the bank takes away the home and all the equity that you've built in the home. So I'm just illustrating to him that if he dies, we want Mary to keep the equity and not the bank if they foreclose on the home. So that's kind of, I hope that makes sense in terms of equity protection. Ask your mentor or your manager if you need more explanation on that. But remember, two things: someone's going to qualify for normal mortgage protection, or someone's going to be qualifying for equity protection in the basically the instance of whole life insurance, okay? Because they could only qualify for like $30,000. So instead of me saying, hey, Bob, you could only qualify for $30,000, but your loan amount's $300,000, I'm going to say, hey, Bob, what you're able to do for Mary is you could cover a year and a half of mortgage payments, a year of mortgage payments, or 9 months of mortgage payments. Which one of these options make the most sense for your budget? The value is in there that you're preserving the equity and that Mary doesn't have to make an irrational decision if she's grieving, and it gives her enough time. So sometimes I call it equity protection, or I say payment protector, or critical time period. It's just a fancy way. I wouldn't say fancy, but it just illustrates the value that you're 70, you can't qualify for $300,000, but I don't want to say that it's only $30,000. All right, I hope that makes sense, and that's my segment on what exactly, mortgage protection or equity protection is going to be.